Hey everyone, Mike McGrean here again with you today. We're going to be looking back in this video to 2023 to see what has transpired over the course of this year as a result of really what's happened over the past couple of years, because it has been pretty tumultuous. Asset classes going up and down as a result of the big moves with interest rates, with the central bank policies, inflation. Stock markets have moved, bond markets have moved, even real estate markets have moved. So we're going to share some slides. We're going to walk through some of those. So without further ado, let's get going. Okay, this first slide is showing us a look back again, stepping back into 2022. You can see that was a year of transformation. Central banks were raising rates at an unprecedented pace in such a short period of time, which had impact on various market classes. You can see the S&P 500, the benchmark index, was lower that year by 19%. The worst performer, of course, was the tech-heavy index, the NASDAQ, down 33% that year in the purple line. But again, that was 2022. We came to 2023, and you can see it's almost the flip side, actually. I mean, the Dow was down 8% the year before. The Dow in blue here was up 8% so far this year. The S&P 500, the benchmark index, up 18% this year. And you can see, actually, basically a mirror of the prior year, where the NASDAQ now was up 35%. Now, when we break it down by sectors of that S&P 500, a nice index because it captures so many different good quality companies across an array of industries. You can see that the communication services, the IT names, of course, they're the best performers, up 46, 49%. But then you can see there's a number of companies down here that really haven't participated too much this year. You know, all the ones here at the bottom, anywhere from 7% to -8%. So it all hasn't been a glory year for every company, but that's why we stay diversified, of course, again, too. When we look at different investment styles, there's growth and value. Value is your typical, big companies, blue chip companies that are slow growers generally, but often provide a lot of good value inside a client account. Growth is more of the growthier names, as you might expect. You can see, of course, the growth names has been the story of this year versus 2022, the prior year. Growth was very much the worst performer. So again, sticking to your plan just shows that sometimes you got to ride out and endure the unfortunate times to eventually be there. So when these sectors start to, again, move in favor, as they do ebb and flow, growth, again, this year has been the stronger performer compared to value. When we look at another sort of way of just valuing growth versus value, you can see in this chart just showing above that line, which is about fair value, you can see that growth is about 1.3 times overvalued or performing better than the value component. These things do ebb and flow. So we might see that pull off again too, where value again will start to pick up that trade. When we look at different portfolios, so this is an all-equity portfolio in the purple. This just simply shows the S&P 500. You know, over the course of the year, those companies have returned about 20% according to this chart here. The other blended amounts here are reducing that equity exposure in that market in favor of increasing fixed income, bond allocations in those portfolios. So for instance, you can see a 60-40, a 60 equity, a 40% fixed income. It has returned, say, 12% so far this year. So again, bonds have not really caught up too much towards the rally so far this year, but again, there's opportunity there, and we'll talk about that in a second. And the top 7 performing companies have generated about a 70% rate of return so far this year. That's all the big tech names, as you would know: Apple, Facebook, Microsoft. But the bottom 493 here really haven't performed too well. Just recently, you can see they were mainly over the course of this year kind of ebbing and flowing between plus minus. Just recently, again, so far from November into December, we've seen a bit of an increase here again in those 493 companies. So again, potential opportunity there for those companies to play catch up. Now, I'm just going to talk about just the effective market timing. Some people might think that you can sit out the market and get back in when things start to feel better. This chart here is specifically showing us if you miss certain key dates, in the market year, your portfolio, it can really do a damaging effect. If you stayed invested the entire year long, you would have benefited from all the ups and downs, maybe a bit of a headache, but the thing is you would have benefited from those big significant gains, which drew your portfolio to an 18% gain for this year. But you can see if you missed certain select days, for instance, sort of the middle one there, if you missed the 10 best days of this year, and you were sitting in cash waiting to get back in, you missed those trading days, your portfolio is flat. You haven't really had a chance to participate in the upside or the downside. So maybe you reacted to 2022 when markets were cratering, falling, and you're sitting in cash waiting to get back in. But the thing is, sometimes if you miss those key dates, it has a damaging impact on your long-term success. So I'd say in this case, stay invested. Looking out over different time periods too speaks to long-term nature of viewing your portfolio and sticking to your long-term plan. If you miss some of those key dates, it's going to have an impact in your portfolio. But again, if you stay invested, you can see that, say, for instance, over a 5-year period here, sort of in the middle, that over a 5-year rolling period, your portfolio has an 83% chance of showing a positive rate of return over that period. The longer you go out, of course, 10, 20, 15, 20 years sort of, the chance of your portfolio having a positive rate of return again is showing here over history has shown that it's been 100%. So riding out the short-term volatility and the noise in the market here where you may have some winners, some losers over time, generally speaking, that quality investment will have a far greater chance of being able to provide you with your portfolio success. If you have any questions and you want to discuss your portfolio, definitely reach out to our team. That's what we're here for. We're here to help. We're here to help make sense of the world around us and to put it all into context for you personally in your portfolio. So by all means, reach out. But again, thanks again for watching. We'll catch up with you again soon.